Hey everybody, so now we're going to jump into looking at discontinued operations. Sorry, I'm pulling up my pen here. And so we might also do earnings per share. We'll kind of see how long this one takes. Our goal kind of is about 15 minutes per chunk. And so we'll make sure we get this first. And so again, we kind of talked about the income statement having two pieces. We have the continuing operations, which is the piece of the business that's expected to continue on. And then we do have discontinued operations, which is a piece of the business that it will not be continuing on, obviously, from its name. And so let's kind of go through an example of how we might report this. And so your continuing operations are at the top of the income statement, and then discontinued operations are the lower section. And so 49er Company has $10,000 of pre-tax net income. 8,000 is pre-tax net income from continuing operations, and 2,000 is from discontinued operations. And so we're going to assume a 30% tax rate, and we just need to kind of report the lower section. So, as we move down, we're just looking at that lower section when we transition from continuing operations to discontinued operations. And so at the very top, obviously we have the portion of our income that is from continuing operations. And so this would actually be a line item on a multiple step income statement. For the test upcoming, this is something that you need to separately report. And then of course, then we apply our tax rate, which gives us our income tax expense. So 30% of 8,000 is 2,400. And so our income from continuing operations is $5,600. And then on the discontinued operations, usually the way that it's going to be reported, and there are several different ways to do it. I'm just sort of going to show you different ways as we move along, but one way, a common way, is to report discontinued operations as one net number. And so you can see what we've done is we just have that one net number over here on the right-hand column, that $1,400, and it comes from the $2,000 of discontinued operations. But then, of course, we have a 30% tax rate, and so basically need to apply the tax rate. So that, if you remember from the last time, we had that intra-period tax allocation. And so this is the tax allocation for continued operations, and then this is the tax allocation from discontinued operations. And so that net number is the gross income less the income tax expense for that income, for a net of $1,400. And then together, that gets us to our net income. And so our net income is $7,000, which of course is, 70% of 10,000. So it doesn't change our net income. It just changes sort of the way we break it down. We have that continuing as one piece, and then discontinued operations as another piece. All right. So what is it? What is a discontinued operation? So sort of kind of main three things are, there's some component of an entity where it's either sold, disposed of, or considered held for sale. I think the classic example of this is General Motors. At one time they had Buick, GMC, Chevy. They also had Saturn, they had Pontiac, they had all these different divisions, these components. And so over, I don't know, it's probably the 2000s or something like that, they started selling off different components. I think Saturn went, and then Pontiac went away, and they just sort of disposing of them. And so in the year that those were disposed of, or whenever they're being held for disposal, they would be separately reported as discontinued operations. So if you want an example of it, kind of go back and look at General Motors. Of course, there have been others over time, but that's the one that I know of the best. So the disposal really needs to be more of a dramatic shift, a major effect. If you're just stopping some product that wasn't doing anything anyway, that's not what we're talking about here. What we're talking about is whole divisions, like large portions of the entity, a major effect on the company's operations, and that would need to be called out separately. All right, so how do we report it? So first of all, you do need to remove every piece of that from continuing operations. And so, if you're doing segment reporting, that's probably a little bit easier for a company, but a company might not be reporting these operations in a separate segment. And so they would need to figure out, okay, if I pull that out, how does that affect my revenue? How does that affect my cost of goods sold? How does that affect all those operating expenses and all those sorts of items, and kind of call them out separately and kind of accumulate them down below. And again, that's sort of a full amount that you report then net of tax at the bottom below continuing operations. Again, if you are going to do this, let's say that I make the decision to sell a significant portion of my business in 2022. On the income statement, I would also, on that 2022 income statement, I would need to report 2021 and 2020 as if that portion of the business were already removed. And so you'd have to kind of have it consistently reported across every year that's being presented. And of course, in this case, that's 3 years income statements. A lot of times when you're reporting this, let's say I was reporting this in 2022, it's because I did sell that component in 2022. And so if you sold it at some point during the year, so let's say in June or whatever, there are really two things going on. First of all, there is the income that entity or loss that entity produced during the year. So you need to report that net of tax. And then there may have been a gain or loss. So when you sell or dispose of it, if the proceeds that you receive is more or less than the book value of the net assets, then you're going to report a gain or loss on that sale. And so just remember there could be kind of two components. And the purpose of this class isn't necessarily to get into the weeds of how you calculate that gain or loss, but rather how do we account for that gain or loss? All right, so you can separate them. They can be one line, but no matter how you report it, it needs to be net of tax. And so we're going to do another example here. So $12,000 of pre-tax net income, $15,000 is from continuing, and the other $3,000 obviously then is from discontinued. They disposed of a unit halfway through the year. Up to that point, they had a loss of $5,000. And then they had a gain on the sale of the disposed unit of $2,000. Both of those numbers are pre-tax. And so how would we present this information? So again, you start with income from continuing operations, you subtract out the income tax expense, and you're left with income from continuing operations. So we have our pre-tax amount, and then we have our after-tax amount of $10,500. And then our discontinued operations come after that. And so we do have a loss from operations of discontinued. So I kind of called them out separately. So this is the result of the operations. And so sort of the two pieces of this are going to be the net gain or loss, and then the tax impact. And so in this case, of course, we had the $5,000 of income, but then we had a $5,000 loss, and then we had a $2,000 gain on sale. So the net loss was $3,000. And so we're just trying to identify that there. And then the income tax benefit, because it's a loss, it's an income tax benefit. So it reduces the taxes. So it's a positive number. And so then that net loss, the loss on discontinued operations, then is the net of the two, which is a negative $2,100, which leaves us with net income of $8,400. So again, we talk about those two things. Notice we have our continuing operations as one item, and then we have our discontinued operations as the other. But again, in this case, we kind of called out the loss itself, or the total loss, and the income tax effect separately. And that is a choice you can make. And on the exam, I'm going to ask that you do that. So we're going to kind of have it as two different lines. All right, so next section, I think we have time, probably not EPS, but we will at least, I think, get through this. Later on, there's a longer discussion of how we account for changes and errors, but we do at least want to introduce it here. And so there are different types of changes. One is called a change in accounting principle. And so basically, you may, have a point in time where you go from one acceptable accounting method to a different one. So as an example, a company may use LIFO for a time and then decide, okay, I'm going to use FIFO now. And so whenever that happens, we kind of need to handle that, because now obviously the way that we're accounting for inventory is different than it had been in the past. So, kind of thinking about this one change, there are really three potential ways that we could account for this change, and this is just where we're going to introduce them. So one's called the retrospective approach, where essentially all presented financial statements, so this year and all prior years that are part of what you present, must reflect the new method. So you can basically go back and for all intents and purposes kind of restate those prior years. There's also what's called the modified retrospective approach, which basically means you apply it to the current year where you made the change, but anything that sort of affected prior years, you just sort of catch up retained earnings. And so the idea there is then retained earnings is adjusted to reflect the change in the approach. So if by going from LIFO to FIFO, our net income increased, $200 for the last 2 years, we would report that as an adjustment to our retained earnings, an increase of $400. And so, but we're not going to restate those prior years. We're just going to show it as one adjustment to retained earnings in the current year. And then finally, the prospective approach basically says just use the new method going forward. Don't adjust retained earnings. It is what it is. And so, obviously, if you calculate your ending inventory differently this year, then your cost of goods sold is going to look very different than what you did the prior year. And so all of that kind of gets sort of rolled up, and you just kind of move forward. Don't worry about adjusting retained earnings. Don't worry about restating anything. It's just use the new approach going forward. So if it's a mandated change, meaning that GAAP, for whatever reason, is not allowing a certain method, and so you must use a new method, then you can use any one of the three. If you voluntarily change methods, then you must use the first one, that retrospective approach, which of course provides the most comprehensive information because everything presented is going to reflect that new method. All right, so next we're going to talk about changes in accounting estimate. That's another type of change. Certain things like the useful life of long-term assets, or we talked about the uncollectible accounts. You could change the way that you estimate that. So anytime you make a change in estimate, really there's only one way that you do it, and that's the prospective approach, which, if you recall, that means you don't go back and restate anything. You don't make adjustments to retained earnings. You just use the new method going forward. And so whenever you change your estimate, you just use that new method as you go forward. Don't worry about restating anything. Just kind of march on using that new method. Another type of change is called correction of accounting errors. As you probably already know, maybe you're getting a little bit sense of it, but accounting systems are complex, and transactions are not always easy to analyze. And so there are times where either the system or accounting judgments end up being incorrect, and there needs to be some correction. And so whenever that happens, usually that's going to be discovered, in the same accounting period. So normally, as part of the audit process or even the internal process, the error is identified beforehand. And so it's not, nothing's been sent out to the public. We discover it internally, we make a correction, and off we go. Those are fairly easy, but you do need to make a correction, in your journal. However, sometimes that doesn't happen. Sometimes you actually discover that there was an error in a prior period. And so this is a more serious situation. And so this is where you've actually now presented and provided information to external users that was incorrect. And so you need to obviously fix that problem. It's a pretty serious one. And sometimes people get fired over this kind of thing. And so this is a pretty serious issue. Many times when you have an error, you will need to do a journal entry to adjust balance sheet elements. And the reason why I highlight balance sheet elements is because most of the times the income statement items have already been closed to retained earnings. And so there's no ongoing issue. In other words, we made a mistake in the last period with revenue. We closed revenue to retained earnings. And so revenue doesn't have an ongoing problem, but of course retained earnings does. And so when we talk about those adjusting entries, when you discover an error, most of the time the entries are going to be to balance sheet items. However, it could also require a current period adjustment as well. If, let's say, I had been accruing revenue incorrectly and it spilled over into the processes I was using in the current year, then obviously there'd be sort of two things. There'd be, the retained earnings effect from prior periods, and then maybe the current period sales revenue effect as well. So it can get very complicated in terms of the type of journal entry that may be required. Now, this is the more serious thing for companies is typically what they're going to have to do at this point is issue a restatement. And so they're going to have to go back and correct those prior period financial statements, and they're going to actually have to disclose the nature of the error, and on it would go. And so this can be a very serious thing. Whenever this gets announced, usually the stock market is not happy. Usually managers get in a lot of trouble, auditors get in a lot of trouble. So this is a very serious issue whenever you have one of these errors. And so I just wanted you to be aware of that. I'm going to stop this one for now. And then what we will do is we will pick up with earnings per share next time.